AppLovin Corporation is facing significant market challenges following the announcement of an SEC investigation into its data collection practices. The company's stock fell 14% on October 6, 2025, with an additional decline of 3.28% in pre-market trading, driven by investor concerns over potential regulatory repercussions. The investigation, spurred by a whistleblower complaint and multiple short seller reports, is examining allegations that AppLovin violated service agreements by collecting user identification data without consent from platforms such as Meta, Snap, TikTok, Reddit, and Google to enhance targeted advertising. While no formal charges have been filed, the inquiry raises questions about the company's compliance with platform terms of service. Despite these challenges, AppLovin has shown remarkable growth, with its stock increasing over 80% in 2025 and a 700% surge in 2024, largely due to its AI-driven Axon advertising platform. The company maintains strong financials, with a profit margin of 42.35% and a return on equity of 253.77%. The timing of the investigation is particularly notable given AppLovin's recent inclusion in the S&P 500 index. As the company prepares to release its earnings on November 5, 2025, investors and analysts, who have set price targets ranging from $250 to $860, will be closely monitoring any developments related to the SEC probe, which could significantly influence market sentiment and the company's strategic direction.
Shawbrook Bank's announcement of its planned initial public offering (IPO) in London marks a significant potential turning point for the UK's mid-tier banking sector. The IPO aims to raise Shawbrook's profile in the UK market and fund its growth ambitions, while allowing its current owner, Marlin Bidco, controlled by private equity firms BC Partners and Pollen Street, to reduce its stake. The offering could value Shawbrook at up to £2 billion, $2.69 billion, and the bank plans to offer shares to both retail and institutional investors, aiming for a minimum free float of 10%. This move comes after a period of subdued listing activity in London, and Shawbrook's successful listing could serve as a catalyst for other mid-tier lenders considering public offerings. The broader implications of Shawbrook's IPO extend beyond the bank itself, potentially impacting other UK mid-tier banks such as Aldermore, Close Brothers, and challenger banks like Adam and Starling. A strong market reception for Shawbrook could signal renewed investor confidence in UK banking IPOs, potentially encouraging other financial institutions to pursue public listings. Conversely, a tepid response might lead to greater caution among private equity owners and management teams. The outcome of Shawbrook's IPO will also be closely watched as a barometer for London's capital markets, which have been striving to regain their appeal amid competition from other global financial hubs.
Pfizer Inc. NYSE PFE has seen significant activity among institutional investors, with CFM Wealth Partners LLC reducing its stake by 38.9% in the second quarter, now holding $337,000 worth of shares. Despite this reduction, other investment firms such as Brighton Jones LLC and Revolve Wealth Partners LLC have increased their holdings in Pfizer, indicating varied investor sentiment towards the biopharmaceutical giant. As of the latest filings, institutional investors and hedge funds hold approximately 68.36% of Pfizer's stock, reflecting a substantial level of professional investment interest in the company. In the analyst community, Pfizer has received a consensus hold rating, with price targets ranging from $26 to $33. The stock recently opened at $26.45, reflecting a 3.4% decrease, possibly influenced by broader market dynamics or specific company performance metrics. The company reported strong quarterly earnings on August 5, with an EPS of 78 cents, surpassing the consensus estimate of 58 cents, and revenue of $14.65 billion, marking a 10.3% year-over-year increase. These financial results highlight Pfizer's robust operational performance, driven by its diverse portfolio, including its COVID-19 products under the Comirnaty and Paxlovid brands. The company's forward guidance suggests continued earnings strength, with a projected FY 2025 EPS range of 2.900 to 3.100. This financial outlook, combined with strategic product offerings, positions Pfizer to maintain its competitive edge in the biopharmaceutical industry.
Global Assets Advisory LLC has made a significant investment in McDonald's Corporation, acquiring 1,451 shares valued at approximately $432,000 during the second quarter. This move is part of a broader trend where institutional investors and hedge funds collectively own 70.29% of McDonald's stock, indicating strong institutional confidence in the fast food giant. Other notable investors, such as Brighton Jones LLC and Revolve Wealth Partners LLC, have also increased their stakes in McDonald's, reflecting a positive sentiment towards the company's growth prospects. McDonald's recently reported robust quarterly earnings, with a net margin of 32.21% and a return on equity of 225.52%. The company's earnings per share, EPS, of $3.19 surpassed analyst expectations, and revenue increased by 5.4% compared to the previous year. Despite this, McDonald's stock saw a slight decline of 1.6%, opening at $296.09, possibly due to insider sales activity. Analysts remain cautiously optimistic, with a consensus hold rating and a target price of $325.86, indicating potential for moderate growth. The company also declared a quarterly dividend of $1.77 per share, offering a yield of 2.4%, which underscores its commitment to returning value to shareholders.
Steelpeak Wealth LLC has decreased its holdings in the iShares S&P 500 Growth ETF, NYSEARCA, IVW, by 8.4% during the second quarter, selling 26,834 shares. This reduction leaves Steelpeak with 292,831 shares valued at approximately $32.24 million, making the ETF the 20th largest holding in its portfolio, accounting for 1.2% of its investments. The iShares S&P 500 Growth ETF, which tracks the large-cap growth sector of the U.S. equity market, has garnered significant interest from institutional investors, with firms such as Envestnet Asset Management, LPL Financial, Elite Financial Inc., and Cloud Capital Management LLC increasing their stakes earlier in the year. The ETF is currently trading near its 12-month high at $121.64, reflecting a strong performance with a market capitalization of $66.34 billion and a price-to-earnings ratio of 33.33. Its price has ranged from a 12-month low of $79.31 to a high of $121.92, indicating robust investor confidence in large-cap growth stocks. The recent trading activity, including Steelpeak's divestment and other institutional investments, suggests mixed sentiment about the ETF's future performance, potentially influenced by broader market conditions and growth sector valuations. Steelpeak's strategic portfolio adjustment, as per its latest Form 13F filing with the SEC, reflects ongoing evaluations of market trends and investment opportunities.
Illinois Tool Works Inc., NYSE, ITW, has seen a modest increase in institutional interest, with Woodman Investment Counsel LLC raising its stake by 2.5% during the second quarter, now holding shares valued at $446,000. This move is part of a broader trend of institutional adjustments in ITW holdings, as evidenced by Auto Owners Insurance Co.'s substantial acquisition of 1,427,450 shares in the first quarter, bringing their total to 1,430,000 shares worth approximately $354.65 million. Other significant investors like Nuveen LLC and JP Morgan Chase & Company have also increased their stakes, reflecting continued confidence in ITW's market position. The company's stock opened at $258.76, with a market capitalization of $75.43 billion. ITW reported a strong performance with a Q2 earnings per share EPS of $2.58, slightly surpassing analyst expectations. The company's revenue for the quarter was $4.05 billion, indicating a 0.6% year-over-year increase. ITW has set its fiscal year 2025 guidance at an EPS range of $10.35 to $10.55, and analysts forecast a full-year EPS of 10.39. The firm recently announced an increased quarterly dividend of $1.61 per share, up from $1.50, representing a forward yield of 2.5%. This dividend increase underscores ITW's robust financial health and commitment to returning capital to shareholders. Analyst sentiment remains mixed, with recent upgrades and downgrades reflecting varied perspectives on ITW's future performance. While Wells Fargo raised its target price to $250, maintaining an underweight rating, Truist Financial downgraded the stock from buy to hold with a target price of $283. The stock's average rating is reduce, with a consensus price target of $261.58. These varied ratings suggest a cautious outlook among analysts, balancing ITW's solid financial metrics against broader market uncertainties.
The Walt Disney Company, NYSE, DIS, recently saw an increase in stock holdings by CFM Wealth Partners LLC, which expanded its stake by 11.7% in the second quarter, now owning 2,731 shares, valued at $339,000. This move is part of a broader trend among institutional investors and hedge funds, which collectively own 65.71% of Disney's stock. Notable changes include J. Safra Saracen holding AG's 8.1% increase in shares, and Wedge Capital Management's significant 8,744% boost in holdings. These adjustments reflect continued confidence in Disney's market position. Despite a challenging economic backdrop, Disney's financial performance remains robust, with the company reporting earnings per share, EPS, of $1.61 for the latest quarter, surpassing analyst expectations of $1.45. This performance is underpinned by a revenue increase of 2.1% year-over-year, totaling $23.65 billion. Despite a mixed market environment, analysts maintain a generally positive outlook, with an average moderate buy rating and a consensus target price of $131.18. The company's strategic focus on its diverse entertainment segments, including its video streaming and television content, continues to drive investor interest and market stability.
CoinShares International Limited has introduced the CoinShares Altcoins ETF, NASDAQ DIME, a new financial product designed to simplify investment in the altcoin market for U.S. investors. Traditionally, U.S. brokerage accounts have only offered access to Bitcoin and Ethereum ETFs, limiting exposure to the broader digital asset market. The DIME ETF aims to change this by providing access to a diversified portfolio of altcoins through standard brokerage accounts, eliminating the need for crypto wallets, exchanges, or private keys. This ETF tracks the CoinShares Compass Altcoins Index, which is rebalanced quarterly to manage volatility, offering exposure to various Layer 1 blockchains and interoperability protocols, including Solana, Sol, Polkadot, DOT, and Cardano, ADA. The introduction of the DIME ETF marks a significant development in the U.S. crypto investment landscape, bridging the gap between traditional finance and the expanding blockchain economy. By facilitating easier access to altcoin investments, DIME could attract a broader investor base looking for diversification in the crypto space without the complexities of direct crypto asset management. The ETF's management fee of 0.95% is waived for assets up to $1 billion until September 30, 2026, providing an incentive for early investors. Scheduled to list on NASDAQ on October 7, 2025, this product could potentially reshape how investors engage with the altcoin market, offering a streamlined approach to participating in the digital asset sector.
The main financial event in the article is the unveiling of Budget 2026 by the government, which primarily focuses on addressing the housing crisis by incentivizing the construction of new homes. Key measures include directing state finances towards infrastructure and housing development, with a significant reduction in VAT on newly built apartments from 13.5% to 9% to encourage developers and investors. The budget also extends the renter's tax credit for 3 years and maintains existing affordability measures for prospective homeowners, such as the Help to Buy scheme. However, there are minimal changes for current renters, landlords, and middle-income earners, with no substantial new measures to alleviate cost of living pressures. The budget's broader impact aims to stimulate the housing market by making apartment construction more financially viable, potentially increasing housing supply over the coming years. Developers are the primary beneficiaries, with additional incentives like exemptions or reductions in corporation tax on profits from specific apartment sales and rental profits in cost rental schemes. While the budget prioritizes long-term housing solutions, It offers limited immediate relief for renters and existing homeowners, with only modest extensions of current tax credits and schemes. The focus on developers suggests a strategic shift towards increasing housing density and supply, which could affect market dynamics and property prices in the medium term.
South Africa's poultry industry is facing significant challenges due to uncertainties surrounding the African Growth and Opportunity Act, AGOA, and U.S. trade policies. During a recent webinar hosted by the Fair Play Movement, industry stakeholders expressed concerns about the U.S. exporting chicken to South Africa without paying anti-dumping duties, a practice that undermines local producers. This situation is exacerbated by the U.S.'s ability to self-regulate exports related to avian influenza, a condition that no other country allows. Isaac Breitenbach, CEO of the South African Poultry Association, highlighted that the U.S. continues to benefit from these trade terms despite South Africa losing its AGOA benefits, further pressuring the local poultry market. The discussion also touched on the broader implications of trade policies on food security and smallholder farmers in South Africa. Matshidiso Lakosa, from the Budget Justice Coalition, emphasized the link between unfair trade deals and food insecurity, advocating for fair trade terms that protect local producers and stabilize prices. Tabil Nkunjana, a senior economist at the National Agricultural Marketing Council, called for more collaboration between the government and industry players in negotiating trade terms. The Poultry Master Plan, which successfully revived the sector in 2019, was cited as a model for future negotiations. However, industry leaders feel sidelined in current discussions with the U.S., threatening the progress made in recent years.